WP Carey stock, ticker symbol WPC. Is this the best REIT to buy right now? WPC is up roughly 9% year to date, which is quite similar to the overall market. The S&P 500 is up 8%. On the 10th of February, WPC presented quarterly results where they beat on both EPS and revenue by a small margin. The reason why people love WPC is because of the dividends. Dividend yield sits at roughly 5% and they have grown their dividends for more than 9 years in a row. But does this also mean that WPC stock is a buy at current prices, or is it a dividend trap? Well, in this video I'm going to show you real quickly what WPC does, the most recent earnings, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does WPC do? WP Carey is a real estate investment trust that invests in properties leased to single tenants via triple-N leases. If we check the most recent earnings report, we see that WPC reported a net income of $209 million. Diluted earnings per share sits at $1. AFFO, one of the most important numbers with REITs, is at $269 million or 1.29 per diluted share. Revenue is up 7.4% year over year, so this looks pretty good to me. AFFO is down 0.8%, which is something that concerns me a bit. But the 2023 AFFO guidance range is expected to be between $5.3 and $5.4, so that's a small increase from the $5.2 they did in 2022. So this is definitely something to keep your eye on. They also increased their dividend with the smallest amount of less than a cent. But okay, it's an increase, so that's nice. For the full year, dividends increased with 0.9%, which is again not the highest amount. WPC has roughly 1,450 properties within their portfolio and an occupancy rate of almost 99%, which is a really good number. Around 392 tenants, which I like as well. It means they are quite diversified. The US represents 64% of the total revenue and Europe 34%. Industrial is their biggest segment with 26.5%, followed by warehouse with 24%, and office with 17.4%. Retail represents almost 70% of the portfolio. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. WPC is a 16.69 billion market cap company with a PE ratio of 34. But since this is a REIT, I don't want to focus on the PE ratio but use the price to FFO. Price to FFO is at 14.4, which is lower than my maximum number of 16. So this could indicate that WPC is undervalued right now. Later in this video I will show you my 3 price targets for WPC, so make sure to watch until the end, since price to FFO is only telling a small part of the full story here. Revenue is at 1.45 billion and in this graph we see that revenue is going up, which is something that I really like, of course. It's not always steady and consistent, but as long as it goes up in the long run, I'm good. Over a longer period of time, we see that margins are going up and down quite a bit, which is of course something that I don't really like. So this is of course something to keep your eye on. EPS is also going up and down in the past couple of years, and this doesn't surprise me because of the 2 metrics before. Analysts expect EPS to increase quite a bit in 2023. Which really surprised me. Revenue is expected to increase at high single to low double digits, which is of course very nice. Return on asset is sitting at 4.8%, which is the average for a REIT. And it's the same story with return on equity. Return on invested capital, the most important number here, is at 2.7%, which is kinda low even for a REIT. I really like it when the current ROIC is higher than the 5-year average, so this is something that worries me a little bit since the current ROIC is lower than the 5-year average. Current ratio is at 0.18, which is fine by me. It should be below 1.5 in most cases. A thing to keep your eye on is the total debt and total cash. I prefer companies who can pay down at least a third of the total debt with the total cash. Right now, total cash is at 168 million, while debt is at 8 billion. So it's very important that free cash flow is growing, since this is used to pay down debt, do acquisitions, buy back shares and all other things. In here we see that free cash flow has grown quite a lot in the past couple of years and is also quite steady and consistent, so this is something that I really like. And if we check the shares outstanding, we see that it's going up quite a lot in the past couple of years. Usually this is not a good sign, but REITs issue new shares to raise capital and grow the business, so I'm not worried that much about this number. Next up are the dividends. Dividend yield is sitting at 5%, which is a really high number in my opinion. Annual payout is at $4.26 and the payout ratio displayed here isn't correct since this is a REIT that uses FFO to pay the dividends. Right now FFO is at 1.29 as we saw earlier in the earnings report and in this video. That means a payout ratio of 82%, which is just above the 75% average for REITs, so this looks good to me. The 5-year average growth rate of the dividends is at only 1%, which is not that high. But I'm okay with that since they grew the dividends for 9 years in a row, which is quite impressive, and dividend yield is already at 5%. But does this mean that WPC stock is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6% because of what we saw in the earnings report and also because of the analysis estimations. For the mid assumption I'm filling in 8%, for the high assumption I'm filling in 10%. For the profit margin I'm filling in 34, 37 and 40%. For the free cash flow margin I'm filling in 60, 63 and 66%. PE ratio is not the correct metric to use for a REIT, but we have to fill it in, so I'm putting in 20. For the price to free cash flow I'm putting in 16, 17 and 18, since this company has some growth potential but I don't want to overpay for the growth. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now WPC is at $85. I hit analyze and we see a few green numbers. I don't pay attention to the PE ratio since this isn't a great way to value a REIT, so I'm only focusing on the discounted cash flow value. We have a low price target of $68, which is a decent drop from where they are right now. A mid price target of $85, which is right around the current stock price, and we have a high price target of $108. To me, the mid to high price target is the most justified here, since I expect that they will perform roughly the same way as they did historically. My final conclusion is that I really like the company WPC. Most fundamentals look really good and dividends are also quite nice. Based on the mid and high price target, the stock is undervalued. But to be honest, I do think there are better deals out there right now. One of the most important things with REITs is that FFO is growing and with WPC is growing, but not as high as with some other REITs. If you only focus on the dividends and not so much about the stock price, then WPC could be a great addition to your portfolio. They are quite steady and consistent and the dividend yield is really nice. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.